Our top story, that Fed decision and Jay Powell's press conference, the Federal Reserve announcing the quarter-point interest rate cut yesterday, the first cut in over a decade. Now, the president is still unhappy with the decision, tweeting, "Powell let us down, but at least he is ending quantitative tightening, which should not have started in the first place. No inflation. We are winning anyway, but I am certainly not getting much help from the Federal Reserve." Joining us now is Yahoo Finance's Brian Cheung. Is it the Federal Reserve's mandate to help any administration? It's really something else, isn't it?
Yesterday at one point saying that they are not changing monetary policy to prove a point to the White House at the same time. So even though, yes, the Federal Reserve did indeed lower rates by 25 basis points the first time since 2008, they did not do that to send a message at all or say that they're aligned with the White House is doing. For what it's worth, a pretty noisy meeting yesterday. Not only did they lower rates by 25 basis points, they also ended quantitative tightening, as the president did allude to. Again, this is the process of unwinding assets that it purchased during the financial crisis, in addition to trying to signal what they're trying to do going forward, as markets were teetering almost as the Dow almost down about 400 points at one point during the press conference, all of that while trying to avoid the optics of being influenced by the president. So obviously a very noisy meeting for the Fed. And I had the opportunity to ask Chairman Powell, how difficult is it to say that the Fed needs to ease rates during times when the Fed still sees the economic outlook as favorable? Here's what he had to say.
So again, I see the U.S. outlook as being a positive one. And we have had these global risks to the outlook. There really is nothing in the U.S. economy that presents a prominent near-term threat to the U.S. economy. As I mentioned, there's no segment that's really, or sector that's really boiling over and overheating. Nothing like that.
So Chairman Powell saying that the economy looks okay, but that they needed to cut because of the issues abroad and also inflation running below its target. Again, Powell saying that this does not mean it's just one cut, but said that they need to watch how the data comes in as they weigh future moves.
All right, thank you, Brian Cheung. We are joined by today's panel, this hour's panel. Yahoo Finance's Dan Roberts on my left, Melody Hahm still with us, and on our right. So as we sort of parse the Fed and try and figure out where they're going from here, there's been a lot of criticism of Jay Powell.
Well, I think maybe too much, and yes, he took a hard job, so I'm not trying to say, oh, poor guy. But, you said in your tease there a little bit of a confusing message. Yes, others have called it confusing. Well, I don't know what's so confusing. I mean, he said that the U.S. economy he sees as very strong. The problems right now are global. Everyone agreed that this cut, at least, was going to happen, 25 basis points. That was like baked in already, foregone conclusion. Sure. But I think where people got far out ahead of their skis was assuming that we would get another and maybe two more cuts in 2019. So the instant disappointment, simply because he indicated that we won't necessarily be kickstarting a new season, so to speak, of cuts, that to me was an overreaction. I mean, you got the cut you wanted. Well, in June, the anticipation of the cut was so great that stocks went so much higher. So now you get the cut, but you're disappointed because of what he said.
Yeah, because the press conference is much more enlightening and illuminating than any sort of rate cut in general, because the forecast is more important than what's happening today. And I think the problem is, and Brian has talked about this before, that the Fed does not feel data dependent. You just said that. He cited a strong economy, a strong labor market, yet there are all these nebulous headwinds ahead that he isn't quantifying per se. He's speaking in very, very vague, broad terms, and therefore the market rightfully, I think, has a right to question that, being like, okay, if that is not a surefire guarantee and the U.S. is in a better position than a lot of the global economy, just because other central banks are cutting rates further, does that mean we have to as well?
That question, but you look at what they did. Fact, we know that inflation isn't what they want it to be. That's a fact. But then on the other hand, what they're doing, the stimulus that we talked about with Joe Bruselas, and the fact that they're going to try to get the banks to lend more by cutting the interest they pay on the excess reserves, plus this rate cut, does signal to some investors that there's trouble that perhaps they're not talking about.
Well, it's such a contradiction, isn't it, though? Because if he were to signal, and there's more cuts coming, and I guess people would have liked that, but at the same time, well, then that indicates that we have trouble going on. So how do you weigh those two things? I mean, the sentiment around, we want more cuts, but at the same time, well, you cut when things are bad.
Right. I have to say, if history sets any precedent, in the 4 prior cases, the Fed actually never cut rates just once. So if that's any indication, and as we know, Powell did leave the room open, and we know that Boston Fed's Eric Rosengren and Kansas City's Esther George did dissent, and their voices were quite loud. So we'll see what ends up happening.